There are many theories and there are many portfolio frameworks to explain, to justify the need for a diversified equity or portfolio mix when you're accumulating wealth towards retirement, but there's very little work that's been done trying to justify how that portfolio looks in the retirement phase, and that's what we're going to be doing now. Before we get started on the topic, it's very important to point out a trend that is currently taking place in North America and specifically in the U.S., and that is the rapid decline of defined benefit pension plans. For many, many years, employees were able to retire from their company and be guaranteed that they would receive income for as long as they live. A defined benefit pension, for the most part, guarantees that as long as you live and your spouse lives, you will receive income, possibly inflation adjusted. In the last few years, we have seen a dramatic reduction in the number of plans that are offering lifetime income and the number of plans that are open to new employees. For example, in the year 2001, about 5% of the Fortune 1000 companies that offered defined benefit pensions were closed out. The rest were open, accepting new members. By the time we reached the year 2004, we're now close to 11% of these plans being closed out. What that means is that more and more individuals are approaching retirement without the safety net, the guarantee that they receive income as long as they live. Let me show you some numbers to explain how this looks. For example, as of May 1st, 2006, the number of Fortune or S&P 500 companies that offer a defined benefit pension plan is about 337. Not all of them are open, but those are the number of companies. 337 of them have a DB plan. 82% of them were underfunded. What does underfunded mean? It means that the present value of the liabilities, the guarantees that are being provided to these retirees, is much higher than the assets that they have to support them. 82% of them are underfunded, which means that the assets in the plan are much less than the value of the liabilities. And those liabilities are going to increase as longevity increases. If people live longer, it increases the value of the liabilities. If interest rates decline, real interest rates decline, it increases the value of the liabilities. That gap is getting quite large. Let alone there's 163 S&P 500 companies that don't even offer a defined benefit pension. In fact, when you take a look at the assets of those defined benefit pension plans, about 1.1 trillion are the assets that they have, but the value of the liabilities, and this is a conservative estimate using actuarial valuation methods, is about 1.2 trillion. These companies have about $80 billion in debt that right now is off balance sheet. This will help you understand why we are seeing a dramatic decline in the number of companies that are offering defined benefit pensions. When you are facing these types of deficits, it might not make a lot of sense to continue to have a defined benefit pension plan. In fact, when we look at the wealth in the retirement market, just a mere 10 years ago, the bulk of assets were sitting in defined benefit pensions. 1.4 trillion was sitting in DB plans. 1.3 trillion was in defined contribution plans. Remember, the exact opposite of a defined benefit plan is a plan where you contribute money, you save, perhaps your employer matches it, but the investments, the choices, the risk all sits in your hand, and the least amount was sitting in IRA accounts. But here, when we look at this 10 years later, the most is sitting in IRA accounts, and now defined benefit pension plans have the least amount of assets. Here's another interesting statistic to help convince you that the number of defined benefit plans are rapidly declining, which means that many of us can no longer rely on defined benefit pensions to make it through retirement. In the year 1985, the number of defined benefit pension plans that were registered in the U.S., you have to register your plan with the Department of Labor. If you have a very large pension plan or a small one, you've got to be registered. In the year 1985, there was 112,000 of them. By the time we reached the year 2003, almost 20 years later, there's only 30,000 of these plans left. Literally 2/3 of them have closed down, are no longer open, no longer available. Here's another interesting statistic. In the year 1980, about 28% of the private workforce had access to a defined benefit pension plan. When we take a look at in the year 1990 now, it's now down to about 7%. Look at the reduction. Roughly a third of the private workforce had defined benefit pensions. In the year 1980, we're now down to about 7%. 93% don't have access to this type of a plan. So what's the important point about pensions? What should you know about pension policy right now in the U.S. and North America? Well, first of all, defined benefit pension plans are closing out at a rapid rate. Almost every single week, you read in the newspaper another company that's decided that they're closing out their defined benefit pension plans. These deficits are getting worse. The gap between the assets and the liabilities doesn't seem to be getting much smaller. The funding costs are therefore increasing. It costs companies more if they have to shut or reduce a larger gap. And in fact, many companies are using bankruptcy, Chapter 11 or bankruptcy protection, to offload their pension liabilities just to get out of these so that they continue business without having these liabilities on their books. The accounting treatment will be changing very soon. A lot of companies will be forced to recognize these deficits and to be more accurate in the way they quantify the income. That's going to be yet another reason why defined benefit plans won't be as popular. And what, of course, all of this means is that not only state and local government are worse off, but in fact the retirement risk is shifting to individuals. And this is really the essence of what I'd like to talk about now, and that is that longevity risk or longevity insurance, the traditional insurance that as long as you live you receive income, is dying. It is no longer available as it once was. It is now our responsibility as individuals to make sure that our financial strategies, our portfolio, the products that we buy, provide us with the longevity insurance that many of us have lost by virtue of the fact that we do not have a defined benefit pension. When we take a look at what this means industry-wide, I would say that we, in the accumulation phase of the life cycle, are concerned with wealth accumulation. We want to make sure that we maximize return, subject to constraints on risk. We want to chase alpha. We want to get the best return we possibly have above the benchmark. We want to make sure that our assets grow at the highest possible rate. But I would argue that once we transition to the retirement income market, it's no longer about wealth accumulation. We are now concerned with risk management. At this point in the life cycle, what you want to make sure you're doing is minimizing your risks. It's not about getting the best expected return. It's about worrying how long does the money have to last? What are things going to cost? What will inflation be like? What happens if I get a lousy return early on in retirement when I have so much money at stake? These risks have to be analyzed individually, and what I'm going to do now is spend a bit of time looking at these three risks individually, and the first risk we're going to discuss is what I call mortality or longevity. You will see this table here is a longevity table. It's the exact opposite of a mortality table. It's not the number of people that are dying. It's not the rate at which people are dying in any given year. It shows you the probabilities of living to certain points. So when you are 65 years old, you have survived the teenage years and the childbearing years and the diseases that only afflict the people in their 40s and in their 50s. You've obviously survived infant mortality. Life expectancy at birth isn't relevant to you anymore. What you should be focusing on is the probabilities of achieving certain ages. And in fact, when you take a look at the odds, a 65-year-old has roughly a 34% chance of reaching the age of 90. What this means here is that if we had a large room full of 65-year-old women, and they're all 65 years old, today was their birthday, and we looked at that group over time, we tracked them over the next 25 years. In 25 years from now, a third of this group of women would still be alive. Your clients, if you have a bunch of 65-year-old clients, a third of them will require retirement income for literally 25 years. A third of the females, and you'll notice from the numbers about a quarter of the males, you'll see that the percentages there are about 23%, they will require retirement income for about 25 years.